In this video, we are going to learn what is window dressing. Actually, window dressing is a technique employed by firms to make their financial statements look better than they really are. It is a manipulation of financial statements to show more favorable results for the businesses. There are many reasons for window dressing. Firstly, they use this technique to attract more investors. Then, by using the window dressing, they can improve the share valuation by increasing the profit as well. Sometimes they use this as a tool for the protection from the takeovers. Then, by using this technique, most of the companies are able to reduce their corporate tax liabilities. Finally, it's improved the credit rating. Let's see some of the areas where organizations use window dressing techniques to manipulate their performance as well as the position. When it comes to cash, most of the companies postponing paying their suppliers so that period end cash balance appears higher than it should be. At the same time, when it comes to account receivables, they can record an unusually low bad debt expense so that the account receivables figure look better than is really the case. Not only that, when it comes to depreciation, they are switching from accelerated to straight line depreciation in order to reduce the amount of depreciation charged to the expense in the current period. Not only this, but also in inventory valuations, they are changing the valuation of inventories. Sometimes they may shift from FIFO to LIFO or LIFO to weighted average method to increase or decrease profit. At certain times of years, we know that there are seasonal fluctuations. So firms may have excessive inventory in preparation for a season of high demand. Therefore, an inventory turnover ratio taken at this time as opposed to after the season will be radically distorted. When it comes to expenses, they can increase the profit by capitalizing small expenses instead of charging them as an expense. By recording this, they can manipulate the profit. At the same time, recording supply invoice in the next period can be used to reduce the liabilities on the balance sheet. By doing so, they can enhance the liquidity ratios. When it comes to short-term borrowing, they can obtain it for manipulate the liquidity position of the organization. If they borrow long-term borrowings, what will happen? Then the debt to equity ratio, in other words the gearing ratio, may be hampered. Not only this, but also creation of provisions can be used to manipulate the profit as well. As per the concept of prudence in accounting, it is required to record expenses and liabilities as soon as possible, but revenue only when it is realized or assured. If an excess provision is created, it can reduce the profit as well as the corresponding tax payments. As an analyst or a potential investor, you should enable to identify the methods which can be used to identify the window dressing in accounting. First, you can see, are there any improvement in cash balance because of short-term borrowings or cash flow from non-operating activities? The proper review should be done on the statement of cash flow to check which activity has resulted in cash inflow. At the same time, they can see or identify are there any unusual increase or decrease in any of the accounts balances and the effect of the same in the financials in previous years or prospective years. Furthermore, they can see are there any changes in accounting policy during the year, like changes in inventory valuation from FIFO to LIFO or weighted average or depreciation methods such as reducing balance or shifted from it to straight line or accelerated depreciation, etc. So these will provide clues of window dressing. At the same time, they can see are there an improvement in sales due to different types of discounts and increase in trade payables. They may give clues with regard to window dressing. Window dressing is an unethical practice. As a result, financial statements may lose their true and fair view. At the same time, it is harmful to the shareholders as well as prospective investors. This technique is used to hide the inefficiencies of the management. Therefore, the actual performance evaluation may be mislead. Window dressing may boost up the profit. Sometimes it can be used by management for their personal use. Banks and the financial institutions will be insecure about getting repayment of the loans and the interest on that loans they have funded. At the same time, the company can reach a stage of bankruptcy without noticing in the blink of their eye.